points, some people call it PD array, some people call it areas of interest, whatever you want to call it, it doesn't matter. It's essentially where are we having our levels. Now, most people should already know this. However, I'm just going to cover everything just because, again, I want the foundations all to be set. So let's go ahead and let's talk about what reference points do I personally use. And for me personally, it's just these 5. I see so many different things out there. Again, for me personally, I keep it simple. I use order blocks, breakers / mitigation blocks. Pretty much the same thing. There's just a stop hunt element when it comes to breakers. I use fair value gaps. Number 4 I use is rejection blocks. And then I use old highs and lows, so liquidity pool points. So let's go ahead and let's talk about the first one, which is order blocks. Very, very simply put, we have a bullish order block in here where we have the down closed candle before an impulse push up. And then typically the order block will consist of the opening price. So if this candle is bearish, right, we have the opening price in here. And the open of this candle is going to be constant to our bullish order block. This is typically going to be used like sometimes if like we have some sort of entry where the market, maybe the next candle trades down lower, comes into that level, or maybe we expand higher, and then price comes back and retests that area. Typically, it can be used as an entry model as such. And I'm going to talk about more about entry models later on. That's going to have its own section. Same thing with the bearish order block. We have an up close candle before an impulse leg lower. We have, again, the opening price of that candle. And then this can, again, be used as an area where we look for potential sells. Now, these order blocks, again, they could be on the 15-minute time frame, daily time frame, weekly time frame. Time frame, price is fractal, so it's going to consist on all time frames. However, if we know this is like, let's just say a daily order block, for example, this is a daily candle, we can potentially use this as an area to look for sells depending on the context. Next we have up is a breaker. So we have a bullish breaker here where the market has a push up, we drop lower, and then the market has an impulse push up. So this area in here is essentially our breaker point where the market swept liquidity, right? And this could be a prior low as well somewhere in here. And then the market has an impulse move up. This again can now be used as a potential bullish area to look for buys. So when the market sweeps, and the reason why I like breakers a lot is because, again, it has the liquidity pool element. And when we get into the liquidity pool section, you guys will kind of see how important liquidity is when it comes to my trading. Liquidity at the end of the day is what fuels the market, and the market will typically move after a run-on stop. So it's very important that we understand this component to this PD array or to this reference point. Now, same thing with the bearish breaker. We essentially have this down move, price pushes up, sweeps a high, and then we have a breakdown lower. Now, this area in here, this body of the, this whole range of the candle can be used as a potential sell opportunity if the market comes back in here. And we're going to talk about in the lower time frame confirmation entries, something that we can use as well. Now, you guys will notice as well, if you've watched any of my content from before, I'll typically just use, let's say, that swing low to that swing high and just use the full candle range. And some people are like, hey, but isn't there like an order block here? Yes. And that's why sometimes I'll just mark out the whole range just in case. I know if I'm looking for sells, hypothetically, I know my stop loss essentially has to be above this specific high or below the specific low, but more on that in the later sections. Now, the one that I pretty much is instrumental to a lot of like stuff that I'm going to talk about when it comes to structure is fair value gaps. Fair value gaps are simple. We just have 3 candles. We have one candle, and again, it doesn't matter if it's bullish or bearish. Yeah, as long as we have these 3 candle formation, where in between candle 1 and candle 3, price has not traded inside of here. So this right here is our imbalance because price never retested that area. A good analogy ICT always talks about is like thinking about, if you ever paint a wall, you'll typically have spots that's left over. So these imbalances are kind of similar to that, where price was never traded back up into those areas. And again, imbalances for me personally, they are used for a lot of different things. So they can be used as key levels to look for buys. They can be used as a confirmation of something called displacement, which is why I drew this line here, because typically when we sweep liquidity and have these imbalances, it can kind of give us an indication that the market is off to the races. Inversely, this is a bearish one where we have candle 1, 2, and 3. And then in between candle 1 and 3, price never retested in here. And this, again, is our imbalance. It's also kind of like considered like a gap in a sense. Now, I'm going to talk. Now I'm going to talk about an inverted fair value gap. And there's another fair value gap that we're going to talk about, which I'm going to be talking more about in the confirmation entries, called balanced price range. Again, if you guys have been around for a little while, you're already familiar with that as well. But again, I want to include everything. So inverted fair value gaps, this is important for us to note as well, because sometimes when the market, sweeps a specific liquidity pool, what typically happens is we might have a bearish fair value gap that forms on the down move. But when it gets inverted, this can be a bullish sign for us to look for a potential overall reversal. Inversely, again, let's just say the market has a push up, we clear some sort of liquidity, and then we have a bullish fair value gap. Sometimes what will happen, and what you guys will see as we go along, on what I call a backside move, where the market, again, comes back in here, has a retest, fails to hold and push price, and then price kind of just ignores this area. This is what we would deem as an inverted fair value gap. Same concept. It gives us clues into what direction the market could potentially go to. Now, the next one is we're going to talk about is rejection blocks. Pretty simple stuff. If we have a swing low, typically the buys of the candles is going to be our rejection blocks. So the buys of the candles above this swing low. Inversely, for the bear side, the rejection blocks are going to be the buys of these candles right here. Starts from here, below the high. Now, some people will ask, why do you use rejection blocks? Me personally, I just use them for targets. So if like a market comes back down, like let's say in here, and I took a short position, right? Some people will target the liquidity pool, the swing low. For me personally, I like to target the rejection blocks a little bit before it, just in case, because sometimes price will hit that area and then just reverse. So I personally use it as a methodology for TPs. I'm not using it really for any entry criteria. Now, liquidity pool, again, pretty simple. We have an old low and we have an old high in here. So this is just, an area that we can potentially use for objectives inside of the marketplace, because we know the market will trade from one premium level to a discount level and typically take out one side of liquidity and head to the opposing side. But again, more on that inside of the liquidity pool section. So that concludes the SMC reference points. Again, guys, I'm just going to keep it super simple, super basic for this section. Most people probably already familiar with all these concepts, but again, just as a little bit of a refresher for you guys. Next, we're going to go ahead and talk about advanced market structure concepts, and we're going to get into the granular from the basics to the advanced, and we're going to start implementing a lot of things that I personally use on a daily basis.